In real estate, an assumption agreement is a legally binding contract that lets the buyer of a property take over the seller's current mortgage loan. The buyer agrees to take over the original mortgage agreement's terms and conditions, including the remaining loan amount. The assumption deal usually needs the approval of the lender, who looks at the buyer's creditworthiness and ability to pay the mortgage. The buyer takes on the debt along with the property, so the seller no longer has to pay the mortgage. Here's a real estate example to show what an assumption agreement is. Sarah is buying John's house for $250,000. John is paying 4% interest on a mortgage loan with a remaining amount of $200,000. Sarah would rather take over the current debt than get a new loan. As part of the buying process, John and Sarah agree to sign an assumption agreement. They talk to the lender who holds John's debt and ask for permission to take it over. The lender looks at Sarah's credit history and finances to make sure she can pay back the loan. Once the lender agrees to the assumption, Sarah takes over the existing mortgage. She is then responsible for the remaining amount and must follow the terms and conditions of the original mortgage agreement. She takes over the regular mortgage payments, the interest rate, and any other fees or responsibilities that come with it. In this case, Sarah can benefit from taking over the mortgage because she can use the low interest rate and possibly escape the costs and requirements of getting a new mortgage loan. But by taking over the mortgage, Sarah is also responsible for any missed payments or defaults on the loan. If she doesn't meet her mortgage responsibilities, she could face consequences. The assumption agreement protects both sides. John is freed from his mortgage payment, so he can move forward with selling the house. Sarah can buy the house without taking out a new loan. It's important to remember that assumption agreements are subject to the lender's approval and may have specific requirements and limits. The lender may want the buyer to meet certain credit and financial standards, show proof, or pay fees to take over the loan. Before signing an assumption agreement, both parties should talk to lawyers or real estate experts to make sure they fully understand the terms, implications, and possible risks of taking over a current mortgage. Congratulations! You just added new knowledge from a real estate world. Don't forget to subscribe for more real estate glossary. Thanks for watching.